So I'm long-term bullish on the gold price. I don't think that we're going to have the same rate of escalation that we enjoyed in 2024, 2025, but I'm bullish about the gold price. The consequence of that is that as an investor, I am comfortable with the Francos and the Wheatons and the Agnicos of the world. I also believe that, and I believe them to be effectively at the corporate level riskless. I think the gold price goes higher, and I think they have high quality operations. I think that they will be able to deliver. And so they are investment quality, set and forget investments.
Gold and silver markets are often surrounded by simple narratives, fixed ratios, inevitable squeezes, or guaranteed windfalls, but the real dynamics are far more complex. Currency debasement, mining economics, institutional market structures, and global supply chains all shape the long-term outlook for precious metals. For investors, the key question is not just whether gold and silver will rise, but how to position themselves within a market where large, stable producers offer steady exposure while smaller companies present higher risk opportunities tied to discovery, development, and consolidation. Rick Rule, a veteran resource investor, believes that over the next decade gold is likely to preserve its purchasing power while major fiat currencies such as the US dollar and euro could lose a large portion of their real value. Because of this expectation, he prefers saving in gold rather than holding cash. While he does not expect the same explosive price gains seen in 2024 to 2025, he remains bullish on gold and favors large, well-established mining and royalty companies such as Franco-Nevada, Wheaton Precious Metals, and Agnico Eagle Mines. In his view, these major companies offer relatively lower risk and can benefit steadily from rising gold prices, making them suitable long-term investments for most people who prefer stability over speculation. Rick Rule also explains that while junior mining companies can offer far greater returns, they require much more work, knowledge, and tolerance for risk. Investors willing to study financial reports, management teams, and project details may find opportunities, especially when smaller companies are acquired by larger producers or when developers merge to grow stronger. He also dismisses the popular gold-to-silver ratio theory, such as the idea that silver should trade at 15:1 relative to gold, as overly simplistic. Instead, he argues that silver prices are driven mainly by real supply and demand, noting that most silver production comes as a byproduct of mining metals like copper, lead, and zinc. As silver's industrial uses continue expanding, its price will increasingly reflect industrial demand and mining output rather than historical ratios often promoted in investment narratives. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying close attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
I think that depends on for who. My 10-year outlook is that gold will maintain its purchasing power, absolute purchasing power, and fiat currencies like the US dollar and the euro will lose 75% of their purchasing power. The consequence of that is that I save in gold rather than euros or dollars. So I'm long-term bullish on the gold price. I don't think that we're going to have the same rate of escalation that we enjoyed in 2024, 2025, but I'm bullish about the gold price. The consequence of that is that as an investor, I am comfortable with the Francos and the Wheatons and the Agnicos of the world. I also believe that, and I believe them to be effectively at the corporate level riskless. I think the gold price goes higher, and I think they have high quality operations. I think that they will be able to deliver. And so they are investment quality, set and forget investments. You will see better opportunities, but opportunities with more risk further down the scale. I can invest, not, that's the wrong phrase. I can speculate in the juniors because I've done it for 50 years. I know how to do it. I know how to assess the management teams, and I'm willing to do the work. I'm willing to take the risk. Most of your listeners, Tim, I suspect, would be better off playing the beta game, buying the biggest and the best of the best, and just letting the increase in the gold price in their domestic currency give them the gains that they would hope for. If you have listeners who are willing to do the work, who are willing specifically to spend at least an hour a month on each of their individual holdings, not listening to podcasts like this, but rather reading quarterly reports, uh, reading proxy statements, reading insider filings, there is more money to be made in the juniors, but there is more risk and more work than the average would-be speculator is willing to do. So they need to answer that question for themselves as to where the value is. Listen, the big guys will, because of their size, their efficiency, and their trading liquidity, have higher share prices and hence a lower cost of capital. The tier immediately below that will have a higher cost of capital, which is to say a lower share price. And over 5 years or 6 years, that will either be arbitraged away by people like me, or the big guys will take over the little guys. That's what happens. Markets equalize. The single asset producers are viewed by the market correctly as riskier than the multi-asset producers, because if something goes wrong with their one asset, it cripples them. That discount goes away when they get taken over. By definition, a multi-asset producer that takes over a single asset producer erases the single asset producer discount. So there are arbitrage opportunities in that market. There will be horizontal amalgamations too, not a case where a big guy takes over a little guy, but a case where two or more little guys merge to create a big guy. There will be opportunities for producers to take over developers because they have a lower cost of capital and they have more expertise at developers. And in the exploration sector, because high quality discoveries, say a snow line, are so rare that they will be taken over for eye-popping multiples. But in order to play that game, you have to take real risk and you have to work very hard. I think the ratio is a factoid. I think that prices go to supply and demand, first of all, and they go to utility. The ratio of silver to gold in the Earth's crust has nothing in the near term to do with supply, and it has nothing to do with utility. So while I think that 15 to 1 is useful for generating fees and commissions and also for selling newsletters, I don't think it has much real world implication. It's important to remember that most silver that's produced isn't produced by silver mines. It's produced by copper mines, lead mines, and zinc mines. And if you want to understand something about silver prices, rather than focusing on the relative abundance or scarcity in the Earth's crust, you have to look at production schedules of copper, lead, zinc, and laterally gold. Two, with the changing utilities of silver, which is to say its growing industrial applications and its relative decline to gold as a monetary metal, you need to take utility into consideration as well as supply. What people want is they want a one-size-fits-all ratio, a factoid, something like 15 to 1, to justify an action that would rationally require hard work and long calculation.
Understanding how the silver market functions reveal why many popular narratives about shortages, squeezes, and sudden market collapses are far more complicated than they seem. According to Rick Rule, the silver futures market, particularly through COMEX, is extremely leveraged, with daily trading volumes representing multiples of the actual physical silver available for delivery. Because the exchange is ultimately controlled by the dealers who set the rules, he argues that retail investors expecting a dramatic silver squeeze misunderstand how the system works. In a true delivery failure scenario, the exchange would likely declare force majeure and settle contracts in cash at a price they determine, meaning the dealers would not allow themselves to be trapped in a short position within a market they operate. Rick Rule also explains that some of the structural imbalances in silver developed when prices rose faster than refiners could convert raw or non-standard silver into good delivery bars accepted by institutional markets such as the London Bullion Market Association. While shortages have appeared in retail products like small coins and bars, he notes that large wholesale quantities have still been obtainable. Let's get back to the interview.
Well, it points out the leveraged nature of COMEX, where many days, 100 times the notional value of silver available for good delivery trades every day. Okay. This is a hugely, hugely, hugely leveraged market. But I think it's important for the retail investors who believe that a silver squeeze could be engineered to understand the nature of those contracts, understand the nature of COMEX. COMEX is an exchange owned by the dealers. They set the rules. What would happen if there was an actual failure to deliver would be that the COMEX would declare force majeure, they would shut down the market, and they would cash settle at a price that they set. You will never, ever, ever catch the dealers short in a market that they own. So people need to understand that. That cash settlement price might be very painful for them. It might be pleasant for speculators. But the idea that there would be a buy-in, the idea that the dealers would treat themselves the same way they trade their customers is wrong. That will never, ever occur. I need to say, too, that there were structural imbalances in the silver market, meaning that the silver price went up too fast for the inventories of good delivery in system silver to keep pace. The refiners couldn't keep pace. The further we go without a physical squeeze, the more non-good delivery silver can be processed by the refiners and can become good delivery. A second issue, popular in social media, has been that the Chinese have constrained exports. That the Chinese regard silver as a strategic asset, particularly around their solar industry. That's not strictly speaking true. The Chinese allowed their own citizenry to save in silver, but now they've decided to tax their same citizenry on that silver, sort of countervailing measures. But importantly, what they said was that they would prohibit the export of unauthorized silver, that only authorized dealers could export it. What that meant is that they passed out political favors to 40 of their cronies. They didn't constrain. They constrained. They didn't obviate the export of silver. They just made sure it was their friends who made the money, not everybody else. And finally, what I know parenthetically is that while there is a shortage of good delivery investment grade silver in retail denominations, thus far there hasn't been a shortage of wholesale availability. My former employer, Sprott Inc., through the Sprott Physical Silver Trust, has been experiencing inflows of capital. And by its articles of incorporation, it can't accept deposit receipts. It has to have good delivery physical silver. And thus far, they have been able to buy that silver. So I would argue that in larger institutional denominations, silver is still available. It was not available through the LBMA for a while because paradoxically, the LBMA silver came to North America so that it could get out from under the Trump tariffs. And then the shortage developed rather than in the United States at the LBMA. And so silver has been going the other way. The longer that we go without a short squeeze in silver, a physical short squeeze, a failure to delivery, the lower the probability that that occurs. The refiners are working 24/7, taking non-good delivery silver, refining it, and turning it into LBMA COMEX acceptable product. What is changing, of course, the thing that causes all this to occur is price. I hate to be cynical, but within 6 months, the Bolsa had resumed its prior levels. What one needs to do if one's going to invest in Mexico is have a very, very thick skin about sociology and violence. And one needs to buy the sell-offs, buy the news. The second thing is that if you are an investor in silver and you aren't invested in Mexico and Peru, you aren't an investor in silver. You're a spectator. Yes, silver occurs in other parts of the world, notably Russia, Poland, some in the United States, some in Canada. I, by the way, have stayed invested in Diesel silver. The events are not events I forecast, and by the time I woke up to it, the stock price was off 45%. This is, in my mind, the third best undeveloped silver deposit on the planet. My speculation is that the silver will stay in place long after the violence has subsided, and that Wisla will continue to control that deposit. It's worth noting I could be wrong. It's also worth noting that after 73 years on Earth, I have the psychological and the financial wherewithal to take that risk. Other people may not.
Long-term investment in gold and silver requires balancing stability and risk. Large, established mining and royalty companies provide relatively low-risk exposure that benefits from rising gold prices, while junior and smaller producers offer higher potential returns but demand significant research, diligence, and tolerance for volatility. Silver's value is influenced less by fixed ratios and more by industrial demand, byproduct production, and refining capacity, while gold remains a reliable store of value amid currency debasement. Strategic allocation across these metals, combined with an understanding of market structures and global supply, is essential for capturing opportunities and managing risk. How can investors effectively balance their portfolios between large, stable precious metal producers and higher-risk junior mining opportunities while accounting for market supply, industrial demand, and currency fluctuations? So, stay tuned for clear, data-driven insights into the financial system. Don't forget to like and subscribe so you never miss our weekly updates. Thank you for your continued support, and we hope you enjoy the video.